Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you how to get stocks on the cheap level. We're going to go into two different option strategies that's going to allow you to buy stocks at an absolute discount. In addition to that, I'm going to show you how to use these option strategies in order to magnify your portfolio gains. Now, if you're new to options or you're trying to use options to make some additional money to add to your 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to get stocks for cheap and how you're going to use two different option strategies in order to magnify the gains in your portfolio. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. For today's video, we're going to be using none other than TTD or the trade desk. I'm going to be using this stock for two reasons. The first and most important reason is that I do have it in my portfolio. The second reason, let's go to the advanced feature right here. Let's go to the 1 year chart right here. And here's the second reason. This stock price is still currently below the 200-day moving average. So that's a very good reason to use this stock in order to make this video. Now, before we continue with this video, I always have two requirements from my viewers and also my subscribers. Requirement number one, always make sure to do your own due diligence before investing. What might work for my portfolio may not work for yours. And secondly, always make sure you have an exit strategy before entering any options trade. That being said, let's go ahead and get down and dirty with options. So we're going to go to trade TTD options to the bottom in order to open up the option chain. Now, before we get into the option chain, I'd like to let you guys know, if you guys need help growing a small accounts portfolio, then that is my specialty right there. I do offer one-on-one coaching, and that link is going to be in the description below. Now, here's the first strategy in order for you to get stocks on the cheap level. So we're going to go to buy, we're going to go to call, and now we're going to choose our strike date. Now, the strike date I'm going to be using is going to be June 20th, or rather June 18th, 2026. Now, this gives us 395 days to expiration. Now, I know what you're thinking, that's a pretty long time, but bear with me. I will show you how you're going to maximize this option strategy. So let's go ahead and select that. So we have buy, we have call, and we have our very far out expiration date. Remember, this is number one of the two option strategies I will show you. So now that we have this in our portfolio, we're going to go ahead and we're going to choose our strike price. Now, the strike price I will be using is going to be the $70 strike price right here. Now, the reason I'm using the $70 strike price is because I already do my own due diligence. So I'm fully aware the $70 strike price is a very good strike price in order to pick up this option contract. Now, for this option contract, unfortunately, you're going to have to pay. This one, you're going to have to pay to play. The amount you're going to have to pay is going to be $21.80 or $2,180. Let's go ahead and select that. Now, as you can see here, this option is known as a long call, or rather a LEAPS option. LEAPS stands for long-term Equity Anticipation Security. The reason this is a LEAPS option is because for it to be a LEAPS option, it has to be 365 days out or greater. As you can see, we have 395 days to expiration. Now, we also have what's known as our break even. Our break even here is going to be $91.33. Now we also have something else called our delta. Our delta is 0.69. So please remember these two numbers here. I will refer to them in a second. So before I go ahead and show you how to use this option strategy in order to maximize your returns, let me go ahead and show you the other option strategy. So we're going to keep everything as is with our buy and our call. The only adjustment we're going to make right now is our strike date. So with our strike date now, we're going to go to September 19th. Now, the September 19th strike date only gives us 123 days to expiration. Hence, this is not a LEAPS option. This is going to be a simple long call. Now we're going to go ahead and we're going to choose the exact same strike price, which is $70. Now, with the $70 strike price, keep in mind now, our break even is now $83. Previously, with the LEAPS option, the break even was $91. Now we have to pay for this. The amount we're going to have to pay for this is going to be $13.30 or $1,330. Remember, the LEAPS option we had to pay $21.80. So this option strategy is a simple long call. Now, hopefully you guys see the difference between the LEAPS option and the long call. They're pretty much the same exact option strategy. The difference is the strike date. So in order for it to be a LEAPS option, it must be 365 days or longer. Now, the further out you go with expiration date, the more you're going to have to pay for the options. As you can see here, this is the shorter date one, 1330. The longer date one we just had, we had to pay 2180. The break even for the shorter one is a lot lower than the break even for the longer one. Now, this one is a long call. If you were to buy a long call and have it in your portfolio, there's two things you could do with it. The number one thing I would highly advise you do with it is absolutely nothing. The whole point of having a long call in your portfolio is because one, you have a shorter expiration date. And the reason you have a shorter expiration date is that you're thinking this stock is going to make a move to the upside before this strike date here. Now, if you're thinking the stock is going to make a move to the upside by this strike date, then why do you have to do anything else? Exactly. Now, for those of you who insist on trading, here's something you can do, which I do not advise. Now that you have this contract in your portfolio, you're now allowed to control 100 shares on the cheap side for trade desk. Meaning, if you were to buy 100 shares right now, you'd have to pay $76.29 per share, which is going to net you $7,629. By utilizing this long call option, you're now able to control the same 100 shares at a lot cheaper price. Now, what we're going to do, we're going to go now to sell. We're going to go to call, and now we're going to choose a shorter strike date. Hopefully you guys are following me so far. If you guys are not following me so far, then this is a perfect time for you to sign up for my one-on-one coaching. So now we're going to go ahead and we're going to choose the June 6th expiration date, which gives us 18 days to expiration. Now we're going to go ahead and we're going to choose our strike price. In this instance, we're going to choose our strike price above the current share price. Now remember, very important, our break even was $82. You do not want to choose any strike price less than this break even right here, or you will simply be losing money. Remember, the first thing I told you to do with this long call is do absolutely nothing. This is just a backup if you insist on doing something. So what we're going to go ahead and do, we're going to go ahead and choose the $86 strike price. Now, the $86 strike price, as you can see, is way higher than the $82 strike price, which is way higher than your break even. So even if this trade were to go tits up, you're going to be gaining on both sides. Now, with the $86 strike price, you have a very high chance of profitability, meaning there's a 90% chance that this trade is going to go in your favor. Now, in addition to that, now you're going to get paid. You just bought your long call at $13.30, and now by being able to control 100 shares, you're now going to be able to make $53 on a bi-weekly basis. Now, this is known as a calendar spread. If you'll use a long call in order to sell covered calls, then that's what's known as a calendar spread. Good. So that is how you're able to use stocks on the cheap and then use them to magnify your portfolio gains. Now, let's go back to the original strategy, which was the LEAPS option. So we went buy and we had the strike date of. So here we are back on our original contract. And remember, this one is a LEAPS option because once again, it's 365 days or greater. And we did have the $70 strike price. Now, when you buy this LEAPS option, now you could use this LEAPS option in order for you to make consistent income. With the LEAPS option, you have a similar mindset with the long call. Your mindset is a bullish one, meaning you're expecting this stock to make a move to the upside. Because you don't know quite how soon or how far out this stock is going to move to the upside, that's why we went out for a way longer expiration date. Now, by doing this, once again, you're able to control the stocks for a lot cheaper rate. Now you're able to control the stock for $2,180. Now remember this $91 break-even price right here. We're going to go back to it right now. Now that you have a LEAPS option in your portfolio, now you're going to use that LEAPS option in order to make consistent income. Do not get confused with the two, the long call and the LEAPS. Now, with the leaps, I would highly advise you go ahead and do a secondary options in order for you to make consistent income. So let's go ahead and do that right now. Let's go to sell, let's go to call, and now we're going to go ahead and choose a shorter expiration. Let's go with June 6th. So now we're going to go ahead and we need to choose a strike price above the $91. Let's just call it $92 strike price. Now, the next one up is going to be the $95. So as you can see, with the $95 strike price, which is higher than the 92, we will not be losing money. However, here's the issue with it. You're only going to be making $2. So do not worry. Here's a quite simple way in order for you to counteract that. You simply increase your strike date. So now we're going to go to June 20th. So with the long call, you're able to do bi-weeklies. With the leaps option, you now should be able to do monthlies pretty easy and get pretty decent premium. So here we are on the monthly expiration date, June 20th, 32 days to expiration. Let's see what our $90 call gives us or anything above it. So there you go. So now your 92 is right here, and that pays you around $50. But I'm an ultra conservative investor. So what I would advise you to do is go to the 97.5. The 97.5 is going to give you a 95% chance of profitability, which is extremely, extremely high. Meaning there's a 95% chance this trade is going to go in your favor. Now, for taking that risk, you're going to receive some money. The money you're going to be receiving is going to be 0.25 or $25. Now, I know $25 seems to be a little bit for waiting an entire month, but here's the kicker. Once again, two different option strategy. With the leaps option, you're anticipating a move to the upside, which you do not know when. So that's why you need to choose a very high strike price in order to give yourself enough time. You do not want to lose your leaps option because that's where you're going to make the majority of your money when the stock price goes up. Then you're going to benefit from what's known as capital appreciation, or how we call it on this channel, investment gains. Now, there you have it. Two option strategies where you could control stocks for a lot cheaper and make consistent income. The first strategy is going to be the leaps option strategy. The next option strategy is going to be the long call option strategy. If you were to use your leaps option strategy in order to make consistent income, that new option strategy is now going to be called the PMCC, or the poor man's covered call. If you were to go ahead and use your long call in order to make consistent income, that new option strategy is going to be known as a calendar spread. I know this was a lot to digest, and I always try to make sure that these videos are not too complicated because I really try to make these videos as simple as possible because I too used to be trading with a small account 5 or 6 years ago. So I know how the struggle is. So if you guys have any questions about the long call option strategy, the leaps option strategy, the calendar spread, or the poor man's covered call, feel free to let me know in the comments below. Also, are you guys utilizing any of these option strategies right now in your portfolio? And what stocks are you using it in? Now, go ahead, like the video, subscribe to the channel, and make sure to hit the notification bell to get an alert whenever I post a video. But most importantly, if there's anyone out there struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. We're trying to help as many as we can get away from that 9 to 5 job. Now, until the next video, keep pushing your investments.